Okay, that took a lot longer than I expected. We're live. Welcome in. It is Tuesday, October 17th, 2:02 p.m. Central. Slightly late. Apologies for that. Thank you so much for joining me today. Do make sure you can hear me and see me okay. Looks like all levels are good. Today we're going to cover a story from the news regarding GM and their electric pickup truck plans. And then we're also going to do my Q3 2023 Tesla earnings preview, and we'll do a little bit of Q&A at the end. If I seem a little bit down today, I just read some stuff about the latest conflict, and it's really got me down, and probably I should have put that off before I jumped in, but yeah, it's just I just wish we could have peace, and just people would just stop dying on all sides. Truly horrific stuff. So, okay, let's pull it together. So what I want to start with is GM to delay all electric truck production at Michigan plant until late 2025. This just broke a few minutes ago, so 1:17 p.m. Eastern. So it was about an hour ago. I'll read you a little bit of the story so we can get all caught up on what's going on. General Motors said Tuesday it is delaying production of all electric trucks at Orion Assembly in suburban Detroit until late 2025. GM said the change is to better manage capital investments and implement improvements in an effort to make the new EVs more profitable, which is quite interesting language from GM. I'll read you a couple of the paragraphs and then we'll talk about the sort of my thoughts and why this is kind of a big deal. And let me make myself a little bit smaller so you can see the full screen. General Motors said Tuesday it is delaying production of all electric trucks at a Michigan plant by at least a year to better manage capital investments and implement improvements in an effort to make the new EVs more profitable. GM now plans to begin construction of its next generation EVs at Orion Assembly in suburban Detroit by late 2025 instead of next year. The factory currently produces the Chevy Bolt EV and EUV, which GM will cease producing at the end of this year. So this is quite interesting news. I'm still trying to figure out if this directly impacts the Silverado EV or not. If somebody could find this out for me in the comment section below, let me know, because it's they are very broadly saying that it's going to impact the all electric truck production, which I'm assuming is going to include the Silverado EV, but it could be their next generation trucks. Now, the reason why this is kind of a strange sort of news to break nowadays is multiple fold. Number one, we kind of talked about this yesterday when we talked about the Ford situation with the F-150 Lightning. Pickup trucks are the best selling segment, especially in the United States, and EVs in the US are growing 50% year over year. So it's interesting to see that GM is looking to delay the plans to launch technically a product that would perform extremely well in this market condition and in the segments that Americans buy by a full year, especially when you have the F-150 Lightning, the Rivian R1T, which is another electric truck, and then you also have the Tesla Cybertruck, which has somewhere between 1.5 to 2 million reservations, getting ready to launch here in the next couple of weeks. So one would think that if you really want to be competitive in the market, you would want to move your sort of production closer to where you are now so you can get into the market quick before a lot of players come on board. But GM is claiming getting in and trying to move this later out because of how they have to manage their money. Now, in the article, it states that this is sort of unrelated to the UAW strikes and how that's impacting the companies. As you know, or you may not know, the UAW, which is the union-based workforce that is at the big three, GM, Ford, and Stellantis, they went on strike about a month and a week ago or so. And GM is claiming that this delay is not really impacted by the UAW, but I find that hard to believe that in some way impacts to profitability because of higher costs, because of what the UAW members are demanding as far as increased pay, upwards of 40%, wouldn't impact GM's ability to move their money around. So the broader thing here, and I've been talking about this a little bit on this channel, is I really think the type of financial situation these legacy automakers are in, especially those that are sort of wrapped up in the UAW thing that's going on right now, is that they're going to be forced to get into the EV market at the higher price point and lower volumes because of a lot of the dynamics that we talked about in the past on this channel, primarily around getting battery costs down to a level where you can make mass market EVs. Number two, having the proper technology to compete with the likes of Tesla and Rivian, let's say, in the truck market. And then number three, having demand, ensuring that there's people out there that want your product. The reason why that's a big deal as well, we covered this yesterday, but just in case you're not familiar with it, let's get you caught up. Just yesterday, Ford made a kind of a similar announcement where they're laying off 700 workers who were building the electric version of the F-150, which in this case would be a direct competitor to the Chevy EV trucks, obviously the GM EV trucks. And so now you have two back-to-back news with Ford and GM where they're announcing that, hey, we are slowing down our truck production, one, because we're trying to better manage the supply chain and get better quality with the F-150 Lightning, which was Ford's claim. Now, the thing to remember is the F-150 Lightning has been out in the market far longer than really any other pickup truck. I think that was out. No, the R1T. Which one came out first, the R1T or the Lightning? Let me know in the comment section below. But those two came around the same time. And then you have the Silverado coming out here, not until potentially 2025, if this applies to the Silverado EV, truly. And then you also have a situation where the Cybertruck, again, is coming out very, very soon. So just a very weird situation going on with trucks. And then, again, if we highlight this graph that we've covered before on this channel, you have this situation where the F-150 Lightning sales, which is the blue line, have sort of peaked at the end of last year and are going downwards. And you also have Rivian pickup truck sales also being flat towards being downwards. So then I think there's mounting evidence here that says, especially with the Ford and GM news coming back to back around their EV production cuts and delaying things for the EV trucks, is that the Tesla Cybertruck effect, in a way, I think is very real. Meaning that there's people out there that perhaps want to wait and see what the Tesla Cybertruck is going to have. And that's why you're seeing a reduction in sales for these trucks now. And that's why you have things like GM saying we're going to wait to release ours because, we don't think it's the right time. We don't have the right money in place to make this profitable. If it was a surefire hit and it was a product that it was going to perform extremely well, I bet you a lot of money that they wouldn't be saying we're going to delay it. They're going to want to get it out as quickly as they can, because why would you delay something that's going to make you money, right? So just by them delaying an electric pickup truck, which again is a segment that's growing 50% year over year with EVs, and the trucks, which are by far the largest segment in the US and by far the most profitable mass market segment, why would you delay that, right? I don't know, just questions. I'm just asking questions. Okay, so let's get into the Tesla earnings preview. So I have a Excel spreadsheet, which I want to sort of go down on. Came out weird, which please nobody quote that, that I'm going to go through line by line. And I want to highlight some of the dynamics that are happening before we do that. And the biggest one I want to highlight for this earnings report is that there's some legitimate forces going around lowered costs for EV manufacturers that I want to cover for this earnings season, because as we think about what happened last year and what's going on this year. Last year, we had a situation where a lot of the raw materials for battery production for electric vehicles were through the roof. And now in 2023, those costs have come down dramatically. But for automakers to be able to realize those lower costs, which of course will help their profitability because they're not paying as much to make the cars, that doesn't flow into the company's financials until later on in the year. And right now is about the time, theoretically, where we should start seeing lower costs for these businesses. Now, this is probably the reason why companies like Tesla and other EV makers have gone in and lowered their price for their EVs. As you know, or you may not be familiar, Tesla has dropped their prices massively since the start of the year across all their models, to the point where now the Tesla Model X is eligible for the EV tax credit starting at $79,000, which is their large luxury SUV. And now you got the Model Y and the Model 3 starting somewhere around the $40,000 mark before EV tax credits, whereas in 2022, you couldn't even buy a Model Y for anything under 60 grand, maybe 55-ish, but it was quite expensive, quite expensive. So as we think about that, Tesla and other EV makers have passed on the savings theoretically through the price decreases, and now they should start capturing some of those cost savings from those falling material costs. So a couple graphs I want to highlight. This is from a account called James Cat on X/Twitter. James Cat is a real cat. I've verified with James Cat himself, and he said he's a cat. So we have to believe him. Lithium carbonate prices have collapsed below the previous 2023 low of 170,000 yuan per ton and are now at August 2021 levels. And August 2021 levels was before we had this massive spike in inflation due to COVID. This will undoubtedly flow through Tesla's cost structure, possibly as early as this quarter, but probably by Q4 2023 and beyond. Now, what's interesting about that, as I'm moving myself to the right by clicking on this button, not the other one, it's hard to gauge in time when this is actually going to flow through. It's like you need to be at Tesla buying this product to actually understand where these prices are going to be. But the key highlight here is that peak in 2022, mid 2022, call it, or late 2022, I mean, those prices have absolutely plummeted, again, back down to 2021 levels and really closer to 2018 levels as well. So this is sort of pricing that fluctuates. And for those that are not familiar, I should have probably said this earlier, lithium carbonate is a type of material that a lot of EV batteries use. There's two different kinds of lithium that are primarily used. And even though they don't really, the pricing is different between the two, the general direction of the trends should be a good way to measure directionally where these battery materials are going from a price perspective. So it's kind of like a proxy. It's a proxy to understand how Tesla's costs and any EV costs are figuring from a battery perspective. So you have a giant fall from 600,000 yuan per ton down to 166,000 yuan per ton. So within this context is like what, 70% less? Somebody do the math for me in the comments, something like that. And then there's another chart he did where he said where he looked at nickel. And again, nickel is another chemical that's used in EV battery production predominantly. And you can see, again, same trend. You had a giant spike in 2022. And then in 2023, you've seen a decline back down to 2021 levels, even 2019, 2020 levels pre-COVID. So the cost curve for battery materials is going the right direction to lower costs. And a lot of these should start to be realized either this quarter or next quarter or early next year, but it's coming. And again, I will say that the reason why, especially I think Tesla is comfortable dropping prices the way they have is, number one, obviously they want to make sure that the demand that's out there marries up with their production capacity. And then number two, they know, they've done the math and they know that at some point this will flow through and they'll be able to take advantage of those cost savings. And I'm guessing they're willing to take the hit up front so that they can be very competitive in the market against other car makers. If you look at their pricing versus everybody else, Tesla generally is significantly cheaper for like performance numbers, range numbers, et cetera, et cetera. And so this will help those margins go back up. But again, it's tough to understand exactly how it's going to shake out. So with that in mind, let's go ahead and go through the spreadsheet. For those that don't like numbers, I'm sorry. For those that like numbers, this is heaven. Welcome to heaven. So I'm going to go ahead and zoom in a little bit more so we can look at this thing together. Okay, so I have actual Q3, Q4, Q1, and Q2 numbers from Tesla from 2022 through 2023. Then in this column, and this with the yellow up here, I have what I expect from Tesla for this quarter that's going to report tomorrow, right after market close, probably around 4:05, 4:10 Eastern time PM. So I have auto sales coming in at about $19 billion, auto rec credits at $200 million, and auto leasing at $568. The $19 billion is going to reflect a sort of a slight price decrease if we compare it to how the prices have been quarter over quarter. So in this row, I have basically doing the math to see what the percentage change in the pricing is going to be before what those regulatory credits are for the cars and the leases. It's about a 0.3% 20% lower prices for the cars. And the reason why I'm doing that is even though there was a slight price increase for primarily Model 3 and Model Y in that quarter, if you remember, they went up like, I think it was like $500 or something. I'm also going to take into account that there's going to be more mix shift towards cheaper models because as interest rates rise, you're probably going to have less people buying those cars. And then you also have a lower mix shift of S and X, which would have raised those prices as well. But I do think that I do still expect a slight decrease in pricing, but I am expecting a larger decrease from a cost perspective. And this is what this column looks at, of about 2% quarter over quarter. So I'm expecting prices to go down by about 0.3%, and I'm expecting costs to go down by about 2%. So that shift, that difference will actually give us a little bit higher margin for the quarter. Whereas in the second quarter of 2023, margins came in before those ZEV credits and lease. So I take out the credits and the leases of 17.5%. It goes up to about 18.9% because of improved cost structure on the auto side business. And then if we look at the rest of the earnings as well, so that's the car market. Energy, I'm expecting to go up significantly quarter over quarter, about 20%. I think there's a lot of signs for energy to be performing, that's performing better, and it's growing quite quickly. This is about a 61% growth year over year for the same quarter, and about 20% quarter over quarter to about $1.8 billion. And then services another, which is sort of like the money they make from servicing the cars and also merchandise sales and stuff like that. What's been interesting to see is that for the last few quarters, from Q4 to Q1, Q2, there's been some pretty steady ramp up in how much they're selling through that line item. And in Q2, they ended at about $2.1 billion. In Q3, it came in at 2.3 billion, or I'm expecting it to come in at 2.3 billion. My brother keeps calling me. If you're watching this, Kevin, stop calling me. So 2.3 billion. And so, yeah, so I'm expecting to come in at 2.3 billion because there's been a ramp up of revenue coming through that line. And then you also have to remember that the more cars Tesla has out there on its fleet, the higher the chance this number becomes bigger because there's more cars out there for them to service, to provide, say, extra items for, and also for more people that could potentially buy merch and other things as well. It's not a big line item for the company relative to the car market, but I do expect it to go up. And this one's a pretty high margin. I expect it to be a pretty high margin line in the long term, but right now it's still sort of small relative to the rest of it. So yeah, so that's from a revenue perspective. The cost perspective, I'll let you just glance at here. The math here is just going to do the sort of the gross margins at the bottom are just going to be a reflection of the cost versus the sales, obviously. So really, that's how I see the cost shaking out. And then you can see that it's tough to see on this chart, but for energy, I am expecting the 1420. I hope you know where that joke comes from. Just some of the math I did got me close to that number, so I figured I'd just put that in. I'm expecting energy margin to also go up quarter over quarter. There was a big jump in the second quarter of this year where energy went from 11% to 18%. Now that also came on lower sales quarter over quarter. So they went from 1.3 billion to 1.2 billion, but the margin for energy actually went up from 11% to 18.4%, which is actually quite, I did not expect that. I would have thought that the only way they can get margins up is by pushing a lot of volume. But in this case, it looks like they're doing a lot of improvements from just a cost perspective, from just making the that side of the business more efficient. So that bodes well for the quarter. However, I'd still expect it to be about $1.4 billion. I don't think we're going to have like a massive explosion of energy this quarter, just to try to be a little bit conservative. But who knows? This one could surprise. I would say if there's a line in here that could surprise, it will be energy, because it's tough to track right now with Tesla. It's kind of hard to tell where these guys are shaking out. Let me go ahead and make this a little bit bigger. Yeah, that works. Okay, so that's energy. And then as far as R&D and other stuff goes, this part of the business is kind of like doesn't change too much, honestly. Even though it's up, call it a 26% year over year, it's sort of predictable. I think how the company is growing these lines. This is where their operational efficiency comes in and their operational leverage, what basically means like the top line, all this stuff up here is the factories pushing product. And then this stuff here, the operating expense, is just the cost of like the back office. But Tesla's back office and R&D isn't growing nearly as quickly as the rest of the business, and that really highlights their operational efficiency and their operational leverage. And then income from operations, I have it coming in at $2.5 billion, which is slightly higher than the $2.4 billion from last quarter. And then with interest income of $200, this one, who knows what the number is going to be, might be higher because of the higher interest rates and how much cash Tesla has on hand. And then the expenses and stuff, who knows? I'm just kind of looking at the last few quarters and slapping a number in there, as I think everybody else is. And then I'm also accounting a ratio for the income tax to be similar to the previous quarters. And then net income from non-controlling blah, 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 blah. I saw somebody saw that on the stream. They like that. After you take into account the net income to stockholders after all those costs are accounted for, I'm expected to come in around $2.3 billion, which is down from last quarter's 2.7. And then this will give us a GAAP diluted EPS, so earnings per share, of 0.68. And if you look at the non-GAAP number that typically gets reported out there for EPS, it's probably going to be closer to 0.78, which is close to previous quarter. And the reason why you have a really close, it's about 10 cents off from the previous quarter, but it's not as big of a dip that I think some people might be expecting. And the reason why is because I think energy has a chance to surprise, and I do expect the costs for the automotive business to start coming down at some point. Those lower costs in nickel and lithium and other raw materials should start to hit the bottom line at some point, but we'll see. It could, maybe not this quarter, maybe next quarter. So those are my numbers. Let me know what y'all think about that. Again, this is, why didn't I say this before? Not financial advice, not investment advice. I don't know what I'm talking about. Talk to somebody else. Don't even watch my stuff. But this is just an exercise for me it's fun for me. I like doing this stuff, but in no way, shape, or form do I want to say that I'm going to be correct on this, but it is a fun thing to do as I'm looking through the earnings. But I think where Tesla is right now, let me close out with that, and then we'll go to comments and questions. I really do think that the quarterly earnings for Tesla have almost become kind of a little bit boring as of late, and that's because Tesla is getting ready for its next leg. I think. So what is that? FSD, compact car, and really those two are the major ones, with FSD being the giant one. And then depending how quickly they can realize bot and get that out, actually doing useful stuff and potentially realizing the savings on the company side by using it at the factory or selling it to people for God knows how much. I think until we get there, these earnings are going to become more and more predictable until that point. But then really the biggest thing I'm looking for in the call by far is Cybertruck, is understanding where Cybertruck is, and then correlated to that 4680 production, which is the batteries technology that Tesla's using to power that vehicle, which they'll also be using probably for the compact car and every other product that come out in the future. So really getting a really good understanding on how they're ramping on that. There's a lot of good signs about 4680 ramping quickly, that battery cell, but I really do want to get some insight into how Cybertruck's performing. Where is it at? We're seeing a ton of mules and release candidates being out there. They had one going through Baja not too long ago, doing some torture testing, and it seemed to be performing really well. So getting an understanding of where that product is, but then also in tandem with that full self-driving and really seeing where the company thinks version 12 is going to be, and is it going to be ready for a release soon. So that's where my head is at. Let me know if you have any questions. Write question before your question so it's easier for me to pull up your question. I just said question 1,000 times, and then we'll see we'll see what we've got. Okay. Let's see. I saw somebody with a question here. Eric, thank you so much for your question. Do you think GM can reduce EV production because they are producing fewer ICE vehicles, aka lower EV taxes? Well, I think about that question differently, Eric. The way I think about it is, can GM afford to lower EV production when it's quite obvious that the next generation technology is EV? And is it smart for them to delay the production of a product that technically should be their best-selling product in their whole portfolio long term, because it's in that pickup truck market, which is the largest one in the country, and it's capitalizing on a market that's growing 50% year over year? That's how I view that question. So the ICE side of the business, though, I mean, I will say the ICE side of the business, ICE, for those that are not familiar, internal combustion engine, aka gas, that side of the business very much subsidizes the EV side of the business, right? They make money on gas cars so that they can plug the money they're losing on the EVs for GM and everybody else, really, except for Tesla. And if that starts to go to the wayside, if the ICE car sales start going down, they're actually going to be making less money to be able to subsidize the EV. So if anything, if I'm a legacy automaker, I want my gas cars to go gangbusters, and I'm dumping as much money as I can into, like, for example, that Chevy, the EV production for GM, and I'm pushing the team to say we need to get this out yesterday, and I'm pushing for that super hard. But they're doing the opposite. I think personally that's the wrong strategy, but I am not the CEO of GM. And honestly, I would probably tank that company faster than anybody else in history. So why listen to me? What is the minimum range the Cybertruck should have? Great question. Let me know in the comment section below. What do you think that is? Let's put some range numbers. I think for it to be very successful, I expect it to be, I think 350 to 400. I think will do well. I think that's the minimum, 350. But if it goes above 400 into the 500s, especially for the lower trims or like the base trims, I think it's guaranteed success. I think if it starts at 400 and goes up, it's going to kill. If it starts at 350, I think it's going to do good. And then as long as they have upper trims that can go 400 plus and ideally 500 plus, forget it. Because, pickup trucks are really useful when they're towing and they're hauling. And for you to have really good range under those circumstances, you need to be able to have high mileage. I'll tell you what, though, they did some testing of the Chevy Silverado EV polling stuff. And one of my friends who actually has an F-250 showed me the video. And he said that in the video, and I saw it, the Chevy Silverado EV was able to pull close to 250 miles at, I believe, 10 or 11,000 pounds. That's freaking great. Like, why is GM delaying that, right? That is going to do incredibly well. So the reason becomes that they probably can't make it profitably, or they don't have the right cost structure in place to make that truck actually make money. It might just be a halo product right now. And they're like, crap, this thing is amazing, but it cost us $180,000 to produce it, and we're only selling it for $80,000. So that gives me that makes me really happy that you have GM and the Silverado EV. They're able to get to 400 miles plus without towing, and then they can get to 250 at 11,000 pounds. That's great. And they compared it to a base F-150, and a base F-150 with a full tank of gas can only go 150 miles. But that F-150 is also on the order of $20,000 to $30,000 cheaper than that. The comparison to the Silverado EV. So the technology is there. It's just getting the cost down so that regular people can actually take advantage of that thing. So will the large Cybertruck wiper connect to Starlink? Why not? That's brilliant. Elon, if you're watching this, come on. It's like an antenna that moves up and down. Yeah. Would Ford others be better off long-term in entering EV mass market volume if they hired non-union labor? Fascinating question. The way I think about this is that companies that don't have unionized labor, Tesla, BYD, etc., they are at a natural advantage because of two things. Number one, unions tend to increase the labor costs for a company because the workers there they can maximize their leverage to earn more, get better benefits, which cost the company more. I don't think that's a bad thing, right? Like, let's just think about that for a second. I don't think it's bad for people to get paid what they think they deserve. If there's a market dynamic there for that to happen, great. However, on the flip side, one of the negative things about union, and I think a lot of people that have worked in union environments can attest to this, is that it becomes very difficult to do things that are outside of your role for fear of being fired, or for fear for taking someone's job, or for fear of creating an environment where somebody's overperforming, which makes the math for the how much you're getting paid broken. So what does that mean? That means less innovation overall, because people are not incentivized, I think, to try as hard as they can. So it creates a certain type of culture that minimizes the chances of long-term success and long-term innovation. And it becomes doubly troubling when you have a player or multiple players that are coming to play in that arena now that don't have that, and that don't have that thing. They can make the thing for cheaper because they're not unionized, and they can also do things that the unions would typically think as, worker abuse, or, hey, that's crazy. Like, don't make me work so many hours or stuff. Like they very much have a set of ethics, right or wrong. I'm not judging that, but I'm just saying that that's what the environment will look like, is that you'll have this code of ethics, or whatever you want to call it, that will disincentivize people from going above and beyond to make stuff happen. That is and then you pair it again with technology that's brand new, that's going to require a lot of attention. It's going to require a lot of ingenuity. It's going to require a lot of being uncomfortable and trying stuff out that might get you fired in a union shop. None of that stuff happens at Tesla. None of that stuff happens at, I'm guessing, BYD, because the culture is different. So yeah, I would say that in an innovative, disruptive environment, unions are a liability, not a sort of an asset. My opinion. I could be 100% wrong, but that's how I think about it. Thank you for the question. Fascinating stuff. Adam, conspiracy hat on. Here we go. Woo, here we go. Isn't these strikes with UAW kind of come at the right moment, since inventory is exploding for legacy automakers? Yeah, that's a fantastic question. And, I don't even think that's a conspiracy. I think automakers got ahead of this. So let me give some context here. So what Adam is alluding to is, if you look at the overall inventory levels for automakers, especially around electric vehicles, a lot of them are over 100 days plus. The average EV inventory on hand in the United States is about 100 days if you remove Tesla. And the 100 days is 40 days above the national average of about 60. So they're, call it, what is that math? 60 to 80% above where they want to be from an inventory level. I think legacy automakers were preparing for this. They flooded the market. And then now, once these strikes are starting to impact their ability to produce cars, they now have stuff they can sell, especially going to the fourth quarter, where the fourth quarter is the seasonally best quarter for automakers to sell cars, because in the fourth quarter you have all the Toyota-thons and all these promos and blah, blah, blah. So I think it's just legacy automakers were preparing for it. They were probably using pricing to leverage it. But in the end, these cars, the EVs, are not profitable. So even if you're putting all these EVs on dealer lots and hoping that it saves you through the strikes potentially, those cars are still not going to be sold at a profit. So I don't think it's like the timing thing is interesting, but if you're selling it at not a profit, that's all that matters. And so it doesn't matter if you sell 1 or 1,000. Actually, it does matter, because the more you sell, the faster you lose money, right? So yeah, it's interesting. It's an interesting observation, but I think it was just preparedness by the legacy automakers that this was coming more than anything, the more I think about it. M3 refresh in the United States? I hope so. Which I just saw a bunch of reviews today. I saw one from Auto Trader, and I believe one from CarWow, comparing the Model 3 refresh to other cars. And I think CarWow deemed the Model 3 refresh as the best midsize EV you can buy, and then compared it to a Mercedes, BMW, and a few other ones, and they crowned the M3. Mods, it's CarWow from today. If you want to post it in the live chat below. If you're watching this on recording, you can click on live chat somewhere on your thing, and then there should be a link for that video in the comment section below. Once one of our wonderful mods find that video, should be right on YouTube. Usually Donald is on top of this stuff. Shout out to Donald. By the way, shout out mods. Love you guys so much. Oh, best mod crew in the world. Am I invested in a lithium company? I am not. All right. And Maybe we should end it with this. If Farzad goes on vacation, will Tesla's share price go up again? Yeah. So here's hilarious. Here's what's hilarious. Every time I go on vacation, Tesla stock goes up. Without fail. Every time I've gone on a trip, Tesla stock goes up. Unfortunately, Charles, I don't have vacation planned for a while. So, yeah. Sorry. I guess we're stuck here for a little while. So, yeah. Okay. We'll do one more bonus one from Alex. Thank you, Alex, for your question. Thoughts on what Tesla does with their cash? Is there stuff to invest in, or do they look at buybacks? Yeah. Fascinating stuff around this discussion. If you're not familiar, Tesla has somewhere around $23 billion, $24 billion of cash on hand right now. And they have very little to no long-term debt. So essentially, it's just cash they can theoretically deploy on stuff. And what's interesting about that is there's been a discussion around, okay, Tesla, you got to do something with that cash. You can't just let it sit there. You have to figure out what to do. And the commentary from the company has been, Elon Musk specifically, the CEO, is that, well, we can only deploy cash so fast. We're going as fast as we can. We're trying to be as efficient as we can. And we're not just going to throw money at anything. We're going to be very strategic about acquisitions, investments, so on and so forth. But because Tesla's making so much more money, even in this environment, let's think about that for a second. Even in this environment where the economy is slowing versus last year, interest rates are higher, which are impacting the auto segment. And there's quote unquote more competition from everybody. And they're investing on new factories, and they're building out their full self-driving and their bot programs. And they're building out a factory in Mexico, and they're expanding Berlin, and they're expanding Texas, and they're expanding Fremont, and they're expanding Shanghai. And they're potentially going to think about opening up a factory in India, which is some of the rumors. They are making profits. They're making money every quarter after all that stuff is said. Wild. And so their cash balance is going up while they're growing and investing in all these different things, and while the economy is slowing and interest rates are going up, which makes it harder to buy a car. Not a bad situation to be in. Not a bad situation to be in as a company. So within that context, you think about long-term potential. I feel like from a business perspective, if you're a CEO or an executive at a company and you look at Tesla's positioning from a financial perspective, you're like, wow, I can really execute on the future right now because there's a recession going on. Well, God forbid I say the word recession. There's economic pressures on interest rates that is going to make it more difficult for us to sell cars. We should probably use this time to get ourselves in a position to be super successful for the future. And I think that speaks to Tesla's price cuts very directly, but it also probably speaks to a lot of stuff that we probably don't even know about that they're working on. So I think if they do buybacks, let me actually answer your question, Alex. Jeez, you just sent me on a freaking rant. I think if they actually do buybacks, it's a signal that Tesla has maximized their ability to deploy cash efficiently. And buybacks are a signal that says we are going as fast as we can. And we're done. And on top of that, we feel secure that being in a capital intensive business like a car maker, meaning that they require a lot of cash to do the things they need to do every day, we're comfortable that we're going to be able to survive a higher interest rate environment. And so a buyback signal says that they've done everything they can to make the company better. And if you look at I forget if it was their investor day or their annual shareholder meeting, they had a slide where they had a priority of what they wanted to do with the cash, and buybacks and dividends were like distant fourth, like last one on the list. And then in the first three they had, making sure that they have a secure balance sheet, making sure they're investing on stuff, making sure that they're making improvements, blah, blah, blah. And then buybacks and dividends are last. So then just by the process of elimination, if they start doing buybacks, it means that they've completed the other three, or they feel comfortable that they have enough for the other three. So yeah, so that's how I think about that. So fantastic question. All right, we'll end it there. Tomorrow, big day for Tesla investors. Tesla earnings will come out sometime around 4 to 4:10 p.m. Eastern after market close. However, on this channel, we'll have a giant stream of myself and a bunch of other people about half an hour before market close, and we're going to talk about what we expect from the Tesla earnings report. We're going to cover the earnings report live. We're going to discuss a bunch of stuff on our findings. We're going to go through what we think the company is going to be doing and what are the positives, what are the negatives, what are we happy with, what are we disappointed with, and then we're also going to listen to the call live with all the executives, and then after the call we're also going to do a post-call discussion on everything that was said, usually because those calls give you a lot more nuance about what the company's doing versus what they put in the earnings deck. Sometimes oftentimes. So all right, let's end it there. Love you guys very much. Mwah. I hope you have a fantastic day. We'll see you tomorrow. And I hope you're having the best day possible. And I can't wait to see you guys tomorrow. Take it easy. Bye-bye.